All right, part 5. Let's carry on. KO2. KO stands for knowledge outcome. Communicate pricing, fees, and commissions to clients. Introduction. The Code of Banking Practices states that the bank must provide full details regarding the charges the bank's going to charge and the fees for essential banking services. Information about the charges and the fees must also be available on request. Clients have the right to know whether the fees or charges are negotiable or not and must be given prior notice of any changes to charges or fees. All additional charges, such as penalty fees and overdrawn account fees, must be communicated to the client. Now you will see I bolted and underlined all these words: must, 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 and must. Now, those of you who have already written your RE exams will know that in the RE exam they swap the words must with may, and the words may they swap with must. And there's a big difference between the two words. Hence me bolting and underlining the words must. Now, I don't say that they will also do it in your class of business and CPD tests and exams, but just make sure that you know when it's must and when it's may, because they might ask you, and also do something like the R exams. Swap these words around. This must be done. All those things. It's not may, it's a must. Okay. When a client enters into an agreement with the bank in respect of products and services, the client must, you see, there's another one. This must be done. Not may be done, it must be done. So the client must be informed of what charges and fees will be levied on the various transactions that are usually performed on that account. There are also additional fees that could be levied on the account depending on the type of product that the client has chosen. So 1.4, discuss the difference between pricing, fees, and commission. So when you look at pricing, pricing can be defined as the valuation of something in terms of its price. The price is the value, perceived or actual, of a product. So the value of the product is the actual value or estimated value, perceived value of a product expressed as an amount of money and charged for a specific product or service. The price would be the whole amount that one pays for a product. The price charged for a product could be defined as the fees and charges levied for each transaction utilized over a specific period, usually a month. The total of all fees and charges calculated for a particular month are then levied automatically by debiting the client's account. These debits are processed at the same time every month, and certain products allow clients to choose the date on which the total fee will be levied. When you look at retail banks and pricing, according to the Competition Commissioner of 2007, retail banks use a form of value-based pricing, which means that the price of the product or service is based on the value it creates for the client. In other words, the higher the demand for the product, the higher the price of the product. Retail banks take several factors into account when working out the price of the product. The value-based approach only forms part of the costing structure. The other factors that are considered are client behavior. What products are clients using currently, the economic climate, market research, especially regarding how much people are prepared to pay for a product, what they consider to be a fair price, and competitor pricing. Each bank generally ensures that their pricing is in line with its competitors. There is a trend in South Africa that when banking product prices increases, they tend to increase across banks and vice versa. Products and services must be appropriately priced to attract clients. An organization such as a bank can position themselves for a specific target market if they price their products and services appropriately. So it's not to say that if Bank A pushes up this product's prices, that Bank B, C, D will do the same. That's where all the banks differ totally. This one charges more for this and that one lower for that, but this one more for this and this one lower for that. So they try to stay competitive to get the other banks' clients over to them. Pricing and market segments. The market segments are ascertained through research, and a transactional behavior pattern of various income groups are studied to be able to capture the correct target audience. It is done by providing them with products and services that can match their specific needs at a price that the target market would deem appropriate. Pricing is used either to attract a specific market segment or to encourage the use of a specific product. On the other hand, pricing can be used to discourage a market segment or product use. Right. For example, if a retail bank decides to focus on a specific target market, such as a high-income niche group, to gain market share in this segment, the range and price will be geared at matching the needs of this specific group. However, the bank runs the risk of losing market share if they do not have appropriately priced products for other segments such as the mass market. If the bank wants to attract the middle and mass market to ensure a sustainable profit and grow their market share from a specific market segment, they will need to ensure that the pricing is appropriate for these segments. When a bank wants to discourage the use of a specific product, the price of this product could also be increased. For example, banks would prefer to minimize the number of clients that perform over-the-counter transaction in order to be able to focus banking on a service-oriented business opposed to a purely transactional-based operation. So the banks don't want people to come in the bank and deal with the tellers. So that's why they charge you extra for that. We say never did. Now they do. So they discourage you to go into the bank. So now you will rather go to an ATM to draw money or to deposit money. I know a lot of restaurants also use this. Many years ago, when I was still young and sexy, I used to be a waiter at a very famous restaurant in Pretoria. And I was still in my teens. Today, I'm not young and sexy anymore. I'm just sexy. So at that time, you paid 15 Rand for a hamburger and chips. Now people came in there, they wanted to watch the sport on the TV, so they will just sit and drink beer. And then when the customers come in to eat, then there's no place for them to sit. So the restaurant owner decided everybody must sit and eat. So what the people now did this, then they just ordered a plate of chips for 5 Rand. Now they eat a plate of chips for 5 Rand, and they could sit and watch the rugby and drink beer. So he decided, no, this is still not helping him. So he made another plan. If you don't want to buy a hamburger and chips for 15 Rand and you just order a plate of chips, he charges you 13 Rand for a plate of chips. Now the people complain and said, but the plate of chips is 13 Rand, but for 2 Rand more I get the hamburger and chips. And the guy said yes, because he doesn't want the people to come in, just eat a plate of chips and sit and watch rugby, and then the people want to come and eat hamburgers and chips, they don't have a place to sit. So now, you see what happens? Now the people, instead of paying 13 Rand for a plate of chips, now they pay 15 Rand to eat the hamburger and chips and I can sit there watch the sport, and my boss is happy because he sold the food at the normal price as well. So you can use price to influence people. Okay. An example of this would be the higher pricing of book-based savings accounts. It is a labor-intensive form of dealing with clients and is not a very profitable product. This type of pricing is intended to discourage all those clients who can make use of the more modern card-based savings account and minimize the number of clients that require over-the-counter banking facilities. This pricing strategy could hurt individual low-income earners, especially the illiterate client who is unable to operate electronic mechanisms. Pricing options. Banks offer various pricing options such as standard options that relates to a specific product or flexible options that can be tailored to suit the needs of their client base. Banks have a variety of products in each product category, so even though the pricing may be standard for a specific product, there is a wide range of products available with unique pricing options that could suit the client's needs. Another example, a check account could have some of the following options. Fixed service fee for a set number of transactions, so they will say we charge you 50 Rand a month and you can get 10 transactions for free included. Pay fees per transaction utilized. Each transaction will have its price attached depending on the type of transaction. So they will give you a list. These transactions, and that's what they cost. Minimum balance option. Maintain a minimum credit balance at all times and you qualify for free banking. In the banking industry, pricing generally relates to the structure of prices related to the various products. For example, the various fees charged for transactions and utilization of an account, product, or service. A fee can be defined as a monetary payment charged for services. For example, a management fee for overdraft facilities. It is therefore the price one pays as remuneration for services. Fees can also be defined as charges or payments for services related to account transactions in the financial industry. Banks price their transactions by applying various pricing formulas. Depending on the bank and the specific procedures, transactions can be charged or levied on the following basis. Right, 1.4.2.1 flat fixed fee. It's a flat fee or referred to a fixed fee. Now that word fixed tells you it is a fixed amount charged per transaction. It means that the fee charged stay the same regardless of the amount of the transaction. Whether you pay 10 Rand in or out or 100 Rand in or out or 1,000, doesn't matter. The fee is fixed. It's a flat fee. So some banks charge a flat fee for a package or a bundle of transactions. For instance, they'll charge you 70 Rand, and for that 70 Rand, you can have a 70 Rand once-off fee. You get 35 transactions, regardless of the value or the type of the transactions. Whether it's a deposit, whether it's a withdrawal, or a third-party EFT payment, doesn't matter. Other banks use a tiered flat fee structure. For instance, they will tell you, okay, the first 8 transactions are charged at the flat fee, and after that, they're going to charge you a higher flat fee for the next set of bundles of transactions, maybe for the next 8, etc. So it depends from bank to bank. Then you look at ad valorem fees. An ad valorem fee can be defined as a fee that increases as the value of the transaction increases. The formula for that valorum fee structure generally consists of three parts. They'll charge you a minimum fee or a value related fee that represents the fee calculated on the value in units of 100 Rand or part thereof, and a maximum amount that can be levied. Alright, so that is another structure. That is called an ad valorem fee. So you can say ad valorem, there is, in this word, there's 1, 2, 3 parts of that word, and then you can remember it consists of 3 parts. And what is the 3 parts? Minimum fee, value related fee, and the maximum amount that can be levied. So let's look at an example. The pricing structure with withdrawal, they'll give you R3.50, 65 cents, and 15 Rand. So what does that mean? So it means the first one, the R3.50, that will be your minimum fee. So this is part 1. So they'll charge you R3.50 for the first 100 Rand. So it's also called the base fee. Alright. So what is the second one, the 65 cents? That is part 2. That is your value related fee. So I said, so on top of the R3.50 for the first 100 Rand, they'll charge you 65 cents for each subsequent 100 Rand withdrawn. So every other 100 Rand following. It doesn't mean you're going to pay R3.50 for each 100 Rand. Only for the first 100 Rand, R3.50. So if you want to draw 200 Rand for the second 100 Rand, they're only going to charge you 65 cents. Or part thereof. In other words, if you want to draw 150 Rand, they'll charge you part thereof, which means 50 Rand is half of 100, so they'll charge you half of the 65 cents. In other words, they'll charge you 32.5 cents. Or I don't know, maybe they'll round it up to 33 cents. It depends. And what is part 3? Part 3, but there's a maximum charge. Okay, so they have to stop somewhere. They cannot keep on going. What if you want to draw R1,000,000 Rand? Then you're going to end up paying what? 50,000 Rand bank fees. No. So the maximum fee will be the 15 Rand. The 15 Rand. You see, there is part 3, there is part 2, and there is part 1. That is how they break it up. So let's look at the calculation. If the withdrawal was 755 Rand, the cost will be R3.50 for the first 100 Rand. So now you've taken 755 minus 100. So for that 100 Rand, they're going to charge you R3.50. So then we are left with 655. Alright, left. So the 655 divided by 100 will give you 7 units, because if you take 6, you only got 600. What about the other 55? Okay, so you must withdraw 700, so it's 7 units. So 7 units for the other 100, 7 times 100 Rand of the, you see, 7 units of the 100. And then we said this, the next one, the blue, is 65 cents. Okay, so then we must make, I'll do it in blue for you, 7 times 0.65 cents, and that will give me R4.55. There we've got R4.55. So for the second part, they're going to charge me R4.55. Oh, this was the first one. me just mark the first one. So the total cost of this transaction could be R3.50, the first part, plus the R4.55. This one. And if you add the two together, it will be R8.05. Does that make sense to you? This is just an example of a calculation. All right. The banks will decide whether they want to take part thereof. Some banks will do it, some banks won't do it. So you must just make sure. But in this calculation, they didn't do part thereof. They just broke it up in that way. Let's say, for instance, we worked out and it was more money. If it was, let's say, in the thousands, it would have been, so if it was 7,550, right, then everything would have been more. And then we this is not just an example, then we might have been at the amount of R80.50. But you will not pay R80.50 because why? The maximum amount is R15. So if you do a calculation and you get to anything more than R15, more is ignore. All right? Ignore more. So you will never pay R80 or R20 or R30. The maximum charge will be R15. You'll stop there. So if they do give you a calculation and you get to R16 or R15.50 or R15.05, the maximum is R15. All right. Please remember that. Then you look at the banded fee. All banks do not use this fee structure. A banded fee is like a tiered rate option. The higher the value of the transaction, the higher the fee is. All right, so the more money you want to take, the higher you're going to pay. The banded fee works similarly to the ad valorem fee, but it is simpler to calculate. So let's have a look at this. The band for withdrawal could be made up in the following way. Cash withdrawal. Up to R600, the fee will be R4. 600 to 1,200 Rand, it will be R8. And 1,200, the maximum you've got in your bank account, will be R16. And that is it. Now, when you look at commissions, the commission is a fee charged by an agent or a broker, for instance, an intermediary, for facilitating the transaction. The term financial intermediary includes banks, investment companies, insurance companies, etc. Intermediaries assist in the transfer of savings from individuals with excess money to those that need capital for investments. In practice, an intermediary service can be defined as the facilitation. And please, I want you to know this, it might also be questions. An intermediary service, and those of you who've done RE5 or RE1 will probably recognize this and remember this, or know this. So intermediary service can be defined as the facilitation of a final transaction where the service is not regarded as providing a recommendation or not giving advice regarding financial products. For example, it is the processing of claims or the collecting of premiums. All right. The commission is compensation received by a broker or insurance agent paid by the insurance company and is a percentage of the insurance premium or a percentage of a portion of the insurance premium. They get the percentage commission. They cannot work for free, for mahala, for nada, for zippo, for nuts. What are they going to eat? They must be at least able to buy bread. Otherwise, they will starve to death. Then, we're looking at explain the relevant pricing relevant to each product category. So when you look in the introduction, banks offer a range of pricing options to consumers. These pricing options are advertised and vary from bank to bank. Bank officials need to research the pricing options for the various product categories at their specific bank. Each authorized FSP is licensed to sell certain phase products. These products are defined and grouped in product categories. And FSPs may have various licenses concerning different product categories. The product category may also have different products falling in the main category, and these are called subcategories. So might work like this. You've got category 1, all right, but then you've got different products. So there will be a category 1.1, a 1.2, a 1.3, a 1.4, and these 0.1, 0.2, 0.3, 0.4, they are all called subcategories. Okay. Once again, you will, if you did REs, you will know this, because there you also learn about this. And that is the end of part 5. If you've got any questions, there's my email address. Please feel free to ask me and send me an email. And I'll see you in the next part. Best of luck.